How banks track your purchases. A friend in banking compliance revealed that financial privacy is largely gone. Beyond standard reporting thresholds, banks use a separate flagging system. It analyzes behavioral patterns, with a high weight given to searches about precious metals or cryptocurrency. Banks buy your browsing history from data aggregators. When your searches about buying gold merge with a bank transfer to a dealer, it creates a risk profile. This can trigger a suspicious activity report, even if the purchase is legal. The definition of suspicious is now very broad, including research on how to buy anonymously. The system also uses guilt by association. It flags people who transact with someone already flagged. This automated surveillance is invisible and pervasive. There are three main data streams. Stream 1 is your transaction data. Every payment is categorized. A sudden deviation from your baseline, like a first-time wire to a bullion dealer, elevates your risk score. Stream 2 is your digital behavior. Data brokers sell banks your financial intent scores based on searches and website visits. If this score matches a transaction, the flag intensifies. Stream 3 is network analysis. It maps your transaction relationships. Sending money to a person already flagged raises your own risk score, creating a web of suspicion. Several patterns trigger flags. First, research followed by action. Searching for silver then buying it creates a strong correlation signal to the algorithm. Second, transaction patterns that resemble structuring. Making multiple purchases just under reporting thresholds is a classic red flag, even if unintentional. Third, rapid asset diversification. Suddenly moving funds into alternative assets after years of traditional banking looks like preparation to exit the regulated system. Fourth, privacy-seeking behavior itself. Searches for how to buy anonymously are treated as evidence of intent to evade oversight. Fifth, association with flagged individuals. You can inherit a higher risk score simply by transacting with someone else who was flagged. Once flagged, a multi-tiered system activates. A yellow flag means enhanced automated monitoring with no visible change. An orange flag brings human review, where the bank may ask you to explain transactions. A red flag leads to a suspicious activity report, SAR, filed with regulators. You are not notified, and this SAR stays in a federal database. The final level is account closure, or de-risking, which can make it very difficult to open new accounts elsewhere. Some strategies can help. First, separate your digital and financial life. Use a different browser or VPN for sensitive research to break the data correlation. Second, understand but don't obsess over reporting thresholds. Making one large, reported purchase is often less suspicious than multiple smaller ones that look like structuring. Third, build a consistent financial profile. Gradually establishing a history of precious metals purchases appears less anomalous than a sudden, large buy. Fourth, accept that complete privacy in traditional banking is gone. Operate within the law with clear documentation. Fifth, diversify your banking relationships to avoid being completely unbanked if one account closes. Sixth, document all transactions and sources of funds for quick explanation. Seventh, consider that payment methods like cashier's checks might draw less algorithmic attention than wire transfers. This surveillance infrastructure is operational now. It modifies behavior through its chilling effect. The system doesn't distinguish between a privacy-conscious citizen and a criminal, it only cares about patterns. You must assume all transactions are monitored and act within that reality, understanding that your privacy is now a negotiation.